You're listening to the Ground Transportation Podcast with Ken Lucci of Driving Transactions and James Blaine of PAX Training. Learn how you can build a thriving transportation business with real profits, repeat clients, and enterprise value. And now for your hosts, Ken and James.
So welcome everybody to an exciting episode, another exciting episode of the Ground Transportation Podcast. My name is Ken Lucci from Driving Transactions. We specialize in financial analysis, enterprise valuations, profit improvement, and M&A advisory services. My normal co-host, James Blaine from PAX Training, sadly, he is not here today again. He's out traveling. He's at the Réunion, most likely training a stellar group of chauffeurs, and that's fine. That's good for him. But I am joined today. I've been looking forward to this for a while. I'm joined today by Phil Shetsen, president of Bona Vita Benefits. And Phil, I got to tell you, I've been dying to do this since I saw your presentation at the Chauffeur-driven NLA retreat event in Savannah. So welcome. I want to tee this up a bit, and then I'm going to let you talk about what you do. Nobody gives a better bio than themselves about their business. But why I wanted to have you on was we love what we do at Driving Transactions, and we've been pretty fortunate. We've reviewed about 280 transportation businesses from $1 million to over 150 million. We've been blessed working with the best networks in the industry, the best regional operators and local companies doing financial analysis and valuations. But and I honestly feel like we're experts at what we do because we've just had so much experience with it. But one of the things that's extremely uncomfortable for me is when we speak to transportation operators about exiting and we talk about their financial situation, and we observe that universally, the majority of them are making monumental financial mistakes. Number one, they're not planning for their retirement by opening outside investment accounts, which I hope you're going to cover. They really are getting horrible advice on tax, and some of them are not even taking W-2 income. They don't have 401ks. And I see a lot of them in their prime earning years or even after sacrificing their own income, pouring it back into a business under the delusion, and that's exactly what it is, under the delusion that when they quote, "When I sell my business, it will fund my retirement." And this is why I wanted you on. So I can safely say to you that after reviewing 280 companies, I want every operator to listen to this. And if you don't want to listen to my advice, talk to other operators who've tried to sell, talk to other operators who purchase companies, and by all means, talk to as many successful people who've exited their businesses as possible. But I'd say 90% of industry operators, 90% of operators that sell their businesses, even if they're successful, it's not enough money to fund their retirement. So let me start with teeing you up with some stats on small business sales. First of all, there are 30 million small businesses in the United States. At any given time, 15 to 20% of them are for sale. Half of them are owned by baby boomers, which Phil, I'm sure you see all the time. These people are getting towards retirement age. And that means any given time, 4 to 6 million businesses are for sale. Now, small businesses, here's the stat. For all small businesses that typically average 3 million or less sales in business, which is 90% of private businesses, by the way, only 20% of them will ever sell to any unrelated third parties, and they never sell for what people think they're worth. There's just like, for some reason, this delusion that their business is going to garner millions of dollars. People are lining up around the street corner to buy a limousine company, and it's just not happening. So right. It bothers me tremendously, and it's something I never really encountered until I got into this space, into what we do in 2019. And it's heartbreaking to me to do the best valuation that you can, to give every benefit of the doubt to what they built, and come back with a value that's market value. Right. It can be proven by every transaction that's got a comp. and it's just not what they think it is. And I'm dealing with people that are much older than me. I'm 60. And they're like, I say, what do you have for your retirement? Nothing. This is going to be it. You've been taking practically no W-2 income. So I wanted you on here. First of all, I want you to tell us all about your background and your bio and your company. But then I'm going to ask you some questions. And I want you to be very brutally honest with what every small business owner should be doing. We've got a great audience. We've got some young operators in the audience. We've got some big successful operators that listen to us. But I like to think that it's the power of more voices and voices with expertise and credibility that get people to change their behavior. So first of all, what got you into this? Tell us about yourself.
Thank you, Ken. And again, thank you for having me. I think that what makes me most passionate about the work I do is the common thread that we're looking to serve an audience that, for the most part, is managing a day-to-day business month by month, quarter by quarter, and they don't really have a great insight into what their future looks like. And so I would say that looking backwards, to answer your question of what got me into this, I was a 21-year-old graduate from Rutgers, New Jersey pride.
Rutgers graduate, very nice.
Yeah, Rutgers graduate. And I had entered the marketplace interested in becoming an advisor. And I had taken a few interviews at Morgan Stanley and Merrill Lynch. And what kept me from going the traditional route of being an asset manager, so to speak, was the fact that I couldn't really control my own future, my own destiny. I would never really control my own promotions. It would be relegated to the time and place and the people that were coming in at that time. So when I had a chance to become an advisor on my own, that was really a great opportunity. But again, nobody wants to listen to a 21-year-old, right? Probably knows nothing about life and even less about finances.
Phil, I got to stop you there. Sometimes people don't want to listen to a 60-year-old either, right?
Right.
Especially when you're telling them things they don't want to hear. But so you're an entrepreneur because you didn't want to be a small cog in a big wheel.
Never. And kind of to stem back to what drove me to be an entrepreneur, my father was an entrepreneur ever since he came over here from Russia. He came over from Eastern Europe in 1981. And what I had realized was the very fiber of being an entrepreneur and a wise one was brought upon me because my father, when I was just a young kid, made some really big mistakes and he lost everything. He lost absolutely everything. And what would have been probably a track of middle class had thrusted me into really an impoverished lifestyle. I mean, my parents got divorced when I was a very young kid. My dad, got in a lot of trouble with the IRS. He made some really big mistakes. And when it came time to decide what market I would serve as an advisor, as an entrepreneur, I had decided that it would be my life's mission to help everyone avoid becoming my father, right? Make sure that as many people as at the very least I could educate and coach and provide some guidance, whether they worked with me or not. If I left every single person with just a little bit of a better understanding of what their future looked like and what their options were, that's what made me extraordinarily proud of the work I did, even if there wasn't much success in the first 3 to 4 years, right? And so, what my father did was he ran a business, which you and I had discussed in the past. It was a lifestyle business. It was a business that would not succeed without him at the helm. And that in itself is a major issue for business owners, because if somebody wants to buy a business, right, somebody's buying it either to acquire new market share or as a way to just create cash flow, right? So in this situation, my father made big mistakes with the IRS. He had never figured out how to succeed the business to another party or to his children. And that stems back to relationships and how to manage relationships with second generation heirs, right, of business operators. And so when it came time for me to decide who I wanted to focus on, it was the business owner. So I've been doing this for 14 years. Just to give you a little bit of a background, I started Bona Vita.
You still look like you're 21, Phil, which I find annoying, but that's okay.
It's the hair. It's all the hair I've been able to keep. Although I just had
straight it is.
I just had my first kid a year ago, so it's starting to go gray on the sides. I've done a good job.
Congratulations.
Covering that up. And so in reality, right, over the 14 years that I've been, so to speak, sharpening my pencil, I have taken upon myself to learn as much as I could from mentors. I think mentorship is huge. And I took along estate planning attorneys, corporate attorneys, CPAs, TPAs who manage retirement plan adoption agreements, benefits experts, so that I could really become a holistic advisor to a business owner. In essence, the reality is that I knew that I needed to prepare for the first 10 to 14 years of my career to be of true meaningful value to business owners. And so when it comes time to make an introduction, which CPAs and commercial insurance brokers do often, or estate planning attorneys do, they know that I'm incredibly well versed in all things business owner, whether it's a buy.
So most of your business, not to interrupt, but most of your business is referred business.
Yeah, I don't do any outbound sales calls. I don't cold call anybody. I've been able to build and foster a lot of trust with other professionals in tangential industries who say Phil not only knows his stuff, but his team backs him up, right? And he can really not just plan, but execute, implement, and support along the way. So I've been very lucky, right? I would say that not a lot of 35-year-olds run an organization with 8 employees. Not a lot of 35-year-olds have the breadth and depth of knowledge that I have, accumulated. But when the passion for education and being able to help people is the reason why you're working so hard, it makes it easy, right? And, a lot of people early on in my career said, chase a good job, get a great career, get good salaries, be able to live in the city or wherever you wanted to live, pursue your goals. And I said, the reality for me was if I did what I loved every day, even if I didn't make very much money in the first few years, I would be happy in the long run. And I've been very fortunate to be in an industry where I get to interact with so many different business owners across all walks of life, whether it's the business going from a Series A to a Series B, or a startup, or an organization that's looking to succeed itself to the next generation. There are so many areas of that conversation that I can navigate, not just basically, but in depth, to really help be a resource to a business owner.
So tell us about your major lines of business at Bona Vita Benefits.
Sure. Great question. Where it started and where it is today, it's, everything evolves. Just like you said, you really entered this space in a big way in 2019. We started out doing a lot of buy, sell, and key man life insurance. I mean, that was the, way where I was networking and marketing myself at BNIs and Latips and all these organizations. It was predominantly, what's the situation with your company? How's it set up? Is it a corporation? Is it an LLC? Are there operating agreements? Are there shareholder agreements? And the more you talk about all of these things, the more you find yourself working with a CPA or with an attorney. And if you're interested, truly just thirst for that knowledge, you're going to sit in on those meetings and understand what a shareholder agreement needs to have. Why?
So stop there for 1 second. Life insurance, key man life insurance, and life insurance products. When I think of life insurance, I think, okay, well, the average person thinks, great, it's a benefit for when I die. But no, you could buy tax deferred. It's a tax strategy. It can be a tax strategy. You can borrow against it.
Yeah, absolutely. It depends entirely on the kind of policy you take out, Ken. Just sorry for interrupting you there.
Yeah, tell us about that. So every small business owner, don't think of life insurance as, oh my God, I have to buy it because people think I'm going to die.
Yeah.
Talk about the realities of buying life insurance as a tax mitigation strategy.
For sure. So we're going to get back to the rest of the lines that developed in my business, but I'll touch on this particular area. If you're a business owner that, let's just say, runs a successful company with a partner, one of the biggest challenges, just from a basic challenge that you need to overcome, is in the event that you pass away, by state law, your wife will inherit, or your spouse will inherit, the shares that you had owned in this LLC or at corporation, whatever it might be. Unless, of course, there are operating agreements or shareholder agreements that would suggest otherwise. And in that situation, your spouse may have zero knowledge of how to run a business, but is very much entitled to the profits of that business. Maybe not the compensation, which is oftentimes comes as a surprise to a spouse that inherits a business, right? You're not entitled to the W-2 because you're not actively engaged in working for the organization, but certainly the profits, right? And so one thing that business owners need to understand is that if there is a partnership or multiple partners and you're disinterested in inheriting a spouse or an ex-partner, decedent's partner, spouse into the business, right there off the bat, life insurance is there to provide the liquidity to buy out
100%.
But
100%.
Going back to what you said, Ken, one of the problems is a lot of people don't have a legitimate valuation, and that's incredibly necessary at that moment because you could say my business is worth $5 million, but if you can sit with them and say, no, quite frankly, the legitimate value on a sale or the valuation of the shares is only $2.5 million, then your spouse is only going to find out at the time of your passing that they might be only entitled to $1.25 million in a buyout. And that's not
listen,
what they thought.
A large part of what we do for valuation work is a valuation for the purchase of the key man life insurance, and it is for partnership buyout, and then it's an update. We like to do them every couple of years because we think that's where when the needles move.
Do you think that, and this is a great way for me to ask you a question, having worked with some valuation analysts in the past, how frequently will you do it on a company? Is it every 3 years, every 5? What do you think makes sense for the market?
3. Absolutely. Every 3. Look, you're shortchanging yourself if you're doing it on one bad year, trailing 12 months.
Sure.
And you're also being unrealistic if you're doing it on a year that we just worked with somebody who had a $10 million contract that went away. And I'm like, okay, well, you're really not going to value, the market is not going to pay. This was a sale. The market is not going to pay for a contract that's gone, right? Never coming back. So we like to do every 3 years. Now, we do update when we have retained clients. We do update them every year for the sake of what we do for them.
Sure.
But from a life insurance perspective, it would be every 3 years. From an exit planning perspective, it's usually every 3 years.
Yeah.
So talk about talk about what everybody hates, right? Everybody hates. They do well, and at the end of the year, their accountant says to them, "You owe 50 grand in taxes." Talk to us about life insurance as a tax mitigation strategy.
Sure.
First of all, it's a legitimate expense, by the way. It's a totally legitimate expense.
I would suggest that, CPA would be best to address that. And most times what I've found is that LLCs and S Corps, because they're pass-through entities, don't tend to benefit from insurance deductions the same way that a C corporation does, for instance, right? Where benefits are tax deductible and they don't have to be taxed on. So I would definitely refer back to the CPA on that question. But I will tell you that in the scenarios where they could possibly use a bonus arrangement where they're funding an insurance contract, then you don't need to buy life insurance as a means to just mitigate the risk of a premature passing, right? You could certainly build it into an asset long-term that is leverageable by the business or that is provided to a key executive. It doesn't have to be an owner, right? You can have a key executive in the business that if they were to pass away, it would leave a substantial challenge to the business's operations, their sales contracts, their relationships, and you can reward a key executive with an insurance policy where if they die, the benefit goes back to the company. But if they're alive, then cash accumulates in the contract. And yes, that cash value can be leveraged. It can be withdrawn. It can be borrowed against. I don't want to get stuck on life insurance because it was...
No. Keep going on all your benefits. This is good.
It was a piece of my business that I still am very well aware of. And, I think business owners tend to, I always joke, Ken, if I sit on a plane and someone starts talking to me and I'm not really interested in talking because I have to do work, all I have to do is I say I sell life insurance and they shut up. Okay? They immediately, headphones go on, they turn into the window, and that's it because nobody wants to talk about it. But the reality of it is that so many topics that I address, business owners don't like talking about, right? They don't like talking.
Join the club.
Yeah, they don't like to have to contextualize their futures. They don't want to have to quantify their futures, right? And the problem there is that, Stephen Covey said it best, and I talked about it in my presentation in Savannah, Georgia for the executive retreat. I said it, like, you have to begin with the end in mind. You have to think about where you're going to be 5, 10, 15 years from now. And the business owners that are young enough to hear this and do something with it, right? I hope this serves as some form of motivation to really take stock of where you want to be in 10 to 15 years, because if you continue to buy depreciating assets, this, right? Like what happens in a sale, Ken, right? I'm either buying a phone number, right? And the assets, right? Which is really more of an asset sale than anything else, or a commission-based sale, or I'm doing a stock sale. But how many businesses do stock sales in your industry? I'm just curious.
From what we do, it's 8 out of 10 of them are asset-based sales.
Exactly.
20% are stock-based sales. And the stock agreements selling the actual corporation is usually the larger transactions that we deal with.
But they do it for the reasons that, generally speaking, the rest of the industry wouldn't do it for, right? Like, in your industry, you're doing a stock sale because somebody has an incredible workers' comp or an insurance rate on their policy, and you want to absorb that as opposed to bringing the fleet under your...
There's a lot of good reasons to do stock sales. Mm-hmm. And if the company is extremely well run, there's every reason to do a stock sale. But in a lot of cases, they're not very well run. So you have to do an asset sale because they have, pending liabilities. They've never been profitable. and their books aren't good. So that's what leads people from a perspective of choosing an asset sale versus a stock. They'll make that choice then. We're working on a very large transaction now that is actually rare. It's an asset sale, but it's a business over, let's just say for the sake of argument, it's over $30 million.
Sure.
Normally, those size businesses are stock
That's
sales.
stocks.
So we talked about 40 million small businesses, 90% of them are less than 3 million. What other products do you specialize in?
So I would say that for a business owner that's sub $3 million in revenue, which means that their EBITDA is somewhere, generally speaking, between 12 to 20%, maybe a little bit higher, depending on how many coaches or shuttles they're utilizing. Right?
Average is about 17%. If they get into the motor coach space, it'll be 21%.
Exactly. So in this scenario, the question that business owner needs to address is, can they distance themselves from that business and convert it from a lifestyle business to a business that they can sit back, hire in some great operators, and keep the cash flow coming until obviously, industries change or evolve, and then they have to figure out how to tackle that. So in that scenario, when I thought about it, because I am the sole partner of the organization, I'm the sole owner of Bona Vita Benefits Group. When I thought about what story am I weaving, what fabric am I building here, it's one where you have to think as a business owner on how to attract and retain talent, right? That's spot two for me. Spot two beyond the life insurance when I started a long time ago was, how do you attract and retain talent? And when you're thinking about all of the work that, some of the organizations within the industry do, they're there to help figure out what's competitive pay look like in the marketplace. What are you paying a CDL driver? What are you paying a driver of an SUV or a sedan, right? But no one's really talking about the elephant in the room, which is that a lot of people really tend to, once you get higher up on the comp spectrum, they want to make sure that you're taking care of their welfare, their financial futures, right? And so in this industry in particular, I've found that overwhelmingly, not a lot of people have set up solid benefits to attract and retain talent: medical, dental, vision, short, long-term disability, group life. A lot of people in this space have not thought about a retirement plan, even a basic one. Forget the concept I'm going to bring out a little bit later in this conversation, which is, how does a business owner really take advantage of a retirement program? But, if I'm a 35 or 40-year-old and I'm thinking about my future, why would I want to go work somewhere where I'd have to figure out my own insurance, and I don't think I'm going to have anything to, cross the finish line of my career into retirement with?
That's the number one Achilles heel when small businesses are competing for young talent. The young talent is asking the question, okay, what's my comp? What's my benefits? And what's my position going to look like 3, 4, 5 years down the road? Do you think it's because the small businesses don't have the benefits plan set up? Do you think it's because they think it's really expensive?
I mean, there's two factors. I think that it's a headache, and I do this on a daily basis. We manage benefits for close to 175 companies that are across the industry. I think that for a small business, they say, I don't have the bandwidth or the wherewithal or the knowledge to really be able to, hunker down and take care of something like this. And so oftentimes that leads them to say, I'm not going to even look at it. And that makes it a sticking point for an employee to say, look, I can't continue to work here for more than 2 or 3 years because I'm not putting any money away. My family doesn't have health insurance, and it becomes a problem. I will say, I will say though, in this industry in particular, what I have found in the work I've done with a couple of clients is that your tenure is really, there's a huge gap for tenure, right? And what you find is that the individuals who work with an organization for 3, 5+ years, they tend to have all of these things kind of taken care of through a spouse, possibly, right? Like, I have a spouse, she provides insurance, I'll drive, it's not a big deal, it's good money, I'm good. But for anyone kind of in the middle, I've seen that there really isn't a whole lot of tenure beyond 1 year to 3 years or 4 years. You're either with a company forever or you're in and you're out within the first year or two. And so it's this gap that I think businesses in this industry can really compete on, to suggest, I'm not just going to give you an extra $1 or $2 per hour, which, by the way, is subject to payroll taxes and all the taxes that the employee or the employer have to pay, right, from a payroll perspective. But I'm going to make an offering available to you so you can feel secure in this role long term, right? And so for me, I have found that the headache of trying to figure out how to procure this is challenge 1. The bandwidth on managing this is challenge 2. And challenge 3 is evaluating a comparable, or what I would say is a competitive offering that would attract people to participate.
So what does it look like? What is a benefits plan that you can put into
Sure.
Just a medium-sized limousine transportation company. What does it look like?
Sure. So there's a few ways to enter the marketplace. The first is to say, I have my payroll provider. I'm going to figure out how to source benefits by way of that payroll provider. I can work with the broker. We can link that directly into payroll. A lot of people are unaware that you can set up a benefits program and link it directly into your payroll system so that as you hire or offboard clients or employees, it's very easy to manage itself. An alternative is to work with a professional employer organization, right, which is a PEO, and that in itself is I could do an entire meeting on, but that is a co-employment relationship that you build with a company that is an HRIS system, and they become the single source solution to payroll, workers' comp, unemployment tax filings, and all benefits.
Do you offer PEO or no?
Yeah, absolutely. Of the 175 clients we work with, give or take around 40 of them are with PEOs. Insperity,
No kidding.
Prestige, TriNet, ADP, Total Source, JustWorks. Correct. Yeah.
Nice. So the operator goes from writing payroll checks or using their own payroll service to their employees now become part of a large PEO.
Exactly, precisely. And that co-employment relationship allows them to access what I would say is a possible substantial savings on what they would normally procure in the marketplace as a small business if they were to go route one, right? Where they'd figure out how to work with a broker to procure the medical, dental, vision, and all the coverages, and then figuring out how to tie that in, right, to their payroll system so it's a little bit more automated. Where PEOs, professional employer organizations, find a huge value proposition to individuals in your space is the workers' comp piece, right? And I'm specifically focusing on the operators that use drivers who are W-2 employees, not the IOs so much, right?
I'm with you, 100% with you.
Because if your workers' comp is say $7 or $8 per hundred, because the cost of workers' comp is directly tied back to the risk and the state cost, for that particular insurance carrier, then by blending your organization with the PEO, where maybe 80% of that pooled population is white collar, you're benefiting from an insurance solution that you couldn't access because the PEO is self-insuring and using a captive on the workers' comp, and you're not going to do that unless you're paying $2-3 million a year in premium. Workers' comp is very hard to self-insure because of how big the risks could be on claims.
Sure.
And then in addition to that value, right, you're getting state unemployment insurance reductions because that's an experienced cost, right, based on how much turnover you have in the year, and access to the benefits in what I would say is a Fortune 500 offering, right? Big carriers, national networks, and it's all tied into one system.
So your PEO, what's the smallest size from in terms of employee, or is it annual revenue to be attractive to a PEO? What is it?
So realistically, most PEOs won't play in a space with less than 5 W-2 employees. The risk of the healthcare doesn't outweigh the potential
But that's
loss.
easy. That's easy. That's the typical $1.5 million or above, you'd like to think, 2 million or above. And so you're basically saying to me that if I have 5 W-2 employees, I can get basic Fortune 500 kind of benefits through a PEO.
Correct. And the challenge is that you have to figure out which PEO is the right partner. So again, like as a business advisor, which is really what I call myself, I have letters like Chartered Financial Consultant or CFP after my name, but I really function as an overall business advisor to most clients we work with. And in that space in particular, it's about finding the right partner within the PEO marketplace, right? I mean, there's probably 400 or 500 PEOs in the country, believe it or not, right? There's a lot of them, and it's about finding the right partner. We've recently, and again, this is not to tote or talk about the Association Health Program, but we recently, in September of last year, became the brokers of record to the Association Health Program by way of the National Limousine Association, the NLA. So NLA members who are listening have access to an incredible opportunity to take a similar approach of pooling their employees with a much larger pool. But it doesn't require that you lug along with that the payroll, the workers' comp, the state unemployment. That could sit on its own in what we call a captive, right? A large captive insurance program. And again, people who are listening to this who are involved in captives, they understand the value of them, right? Because it can significantly drive down their cost of their commercial liability, insurance and professional liability, all of that. But in this world, it's a healthcare captive. And so that is a really attractive offering because by way of your partnership or your membership with the NLA, you're able to access that program, right? Without that, you're not able to access that.
See, I wasn't aware that the NLA program changed to you guys.
Yeah, no, it did in October of last year. And of course, like anything, when you become a new broker to a plan, you really have to understand what's going on prior to us joining. But since we've joined, we've really been able to triage some of the challenges that, individuals who participate in it have faced. And we've been able to grow it with the resources that my firm brings, which I think, again, to a small business owner, you don't have the bandwidth for everything. So when we work with our clients on benefits, we give them an in-house HR benefit specialist to work with, not just from an administrative perspective, but we also give them an employee benefit specialist. So if employees have issues, they have somebody they could talk to directly, not a 1-800 number.
Yeah. And you know what? Your CPA doesn't know the HR and the benefits aspects of things. So you basically, you're like having a fractional HR consultant right there as well.
Yeah. I mean, in a way, if I would to change my title, I would say, a fractional CFO, CPO. I mean, there's a million things that I can do for a business owner. And that's where it gets a little tricky, because when people hear the name Bona Vita Benefits Group, they think, oh, the guy does benefits. The guy can do our health insurance or our PEO. But they miss the 401k. They miss the succession planning. They miss the advisory, right? Which, we're going to get to. So you start the business in 2011, Phil Shetsen, that's me, right? You start off with buy sell. A lot of the people we were doing buy sell arrangements for came back to us and said, hey, our brokers really don't know anything about health. I mean, we're small groups. We have 7-8 employees. Can you figure out how to help us out? And this was right around 2014 when the ACA laws started to change how insurance carriers identified small business owners in the marketplace. And we went from 0 groups to about 12 to 15 groups within 6 months. And
Wow.
I said, this is a real niche for me to find myself in. I'm doing the life insurance. I am the insurance guy right now for everyone, which was hard to shake right off later on in life. And so we started building a practice around providing small to medium-sized businesses with benefits administration solutions, connections between the carriers and the payroll systems. And we've really been able to support that with additional staff members that, again, stand in like fractional HR people you don't have to pay for. I mean, that's the benefit, right? Yeah. So that was exciting. And then, another evolutionary, change in my business was that a lot of these business owners eventually came back to me and said, ADP screwed up our 401k. Can you look at it? And this is something I can't begin to tell you, not that I'm going to take ADP's name in vain, because there are some things they do really well, but a lot of these large organizations their sales compensation arrangements are all predicated on moving units, volume, right?
Exactly. And once you're in, I'm going to say it for you. They don't give a shit. They don't care. They don't care about you.
So
in a lot of cases, they don't.
And what's worse about specifically the 401k space, I started getting referred to people who had set up 401ks. When you set up a 401k, that is a legal document. You're setting up an adoption agreement, right? And that adoption agreement, along with the filings, have to be registered with the IRS on an annual basis, the 5,500. And that adoption agreement isn't easy to just snap your fingers and undo. So you really need to make sure that you get your 401k adoption agreement right off the starting line, because if you don't, then there's a strong likelihood that the triage will be ineffective, right? The correction of that adoption agreement, or that the triage will require that you give more to employees than you had ever intended on doing initially. So right around the time where I started getting introduced to 401k opportunities, I said, look, I know what I know really well, life and health incredibly well, dental, vision, all the insurance benefits, the PEO marketplace. But what I'm lacking here is a real genuine understanding for the 401k and profit sharing and pension space. And so what I had done was I'm going to give Peter Coleman a shout out here. He's the managing director of a company called The Benefit Practice. And I said, Peter, I cannot represent 401ks or TPAs unless I know everything about them. I mean, that's literally who I am, Ken. I'm not going to talk about things I don't know. I'm only going to talk about things I do. And I cannot represent myself as a professional in a world where I don't understand it. And
especially if it's that complex, you're right.
Yeah. But that's a sad part, right, Ken? To be honest, a lot of business owners are being called incessantly by salespeople who know how to sell a product, know how to schmooze somebody, but they don't understand how the sausage is made. And quite frankly, once they've moved on from that sale, they're no longer tied to the relationship. Somebody else is in implementation or account director. And so what I found for me is that taking Peter on as a mentor, learning the ins and outs of an adoption agreement, understanding what capabilities profit sharing programs have for companies or business owners, or pension programs, cash balance plans, or variable plans, it equipped me with, again, just another arrow for my quiver, right? Like that's pretty much what it was. And that space has grown dramatically. We now manage 50 company retirement programs across a number of providers.
By the way, so let's stop there for a second. How big do I have to be to offer a 401k plan?
So it's interesting. You might say, oh, don't I have to be a huge employer? No, the answer is that's not the case, right? It's a matter of how you set up the plan. The larger the company, really, when I say the larger the company, I mean when you have more than 15, 20 W-2 eligible employees. Eligibility, just for anyone listening on a 401k, from the 401k perspective, is 1,000 hours or more, right? You become eligible for retirement plans if your adoption agreement is built that way. If your adoption agreement is 1 hour of work, then guess what? Anyone is eligible to participate and get money from the company. And so that's where, again, like, you really need to be careful on how you're advising clients on setting up these programs. But in that sense, companies as little as 5, 7, 10, 12, 15 employees can set them up. And what people don't understand.
We struggle with, we help people with obviously budgeting, financial pro formas, and we've always seen companies struggle with bonus plans. Do you think 401k is a good incentive?
I mean, so you're touching on such an incredible point, and it's a part of my practice that we meet with our clients kind of towards September and October to evaluate the profitability and figure out whether or not there will be a bonus pool. Some years there are, some years there aren't. Bonus pools, what people tend to forget, and they don't do this because they're not paying attention, but they just don't realize it. If I want to give out a $80,000 or $100,000 bonus pool to say 30 or 40 employees, right? Those employees are likely relying on that money to pay for presents, for vacations, for credit card bills. And so when you start talking about shifting a bonus pool to possibly some form of a deferred benefit, like in a 401k or a profit sharing plan, you end up starting to play a little bit of a game of optics, right? How will my employees receive that as a way of maybe still paying out the same 100,000, but maybe putting 25 of it into profit sharing or 401k contributions? But people don't know what's good for them. Like, that's the reality of it, right? And what's good for most people is to save, and most people don't. And so for me,
you're 100% right. I mean, my father taught me what compound interest meant.
And that's
I didn't learn that in school. My father taught me that.
I think Ben Franklin said it's better than sex, right? I think that's actually a Ben Franklin quote, if I'm not mistaken.
I would agree with him. Whether it was Ben that said it or not, compound interest is fantastic.
So the earlier you get to the starting line again there, the better you are, right? Compound interest is very simple, it's a simple, story to tell. The money you earn interest on, that interest will earn more interest long-term. And the earlier you get to a saving strategy, the easier it is to complete. Let me go back to what you asked, right? Really quickly. You said, do I have to be a company of 30 or 40 or 50 or 60 people to do this? The answer is no, but there are also some legislations that have been passed in the last year or two, which, depending on what state you are and depending on how many employees you have, you are mandated to offer a retirement plan. And people are completely, unaware of that as a problem. It's a big sales push for companies like Paychex and ADP, which are trying to sell 401ks. They're saying, get in compliance with us before you get penalized by the state you're in. But again, it's so important and crucial that you set this thing up with the goals of the organization or the ownership at the heart of it. Because if you do it wrong, it's not great.
Yep. And more companies that I deal with where the operators are young, and I've got one particular that we just did a proposal for, and he's doing a great job. But I said to him, he struggles with his number 2, number 3, and number 4 people, and he wants to create a team that will run the business without him. And this is what comes up, is how to bonus out and how to incentivize the team. And how to build a long-term team that will stay with you instead of the constant turnover and transient employees.
I mean, but think about this, right? You know this. If I'm going to pay out $100,000 in bonuses to, say, employees that are making less than $176,000 a year, because that's the Social Security threshold for taxation, approximately, I'm going to have to pay approximately 10% in a payroll load between workers' comp, Social Security, Medicare, and possibly some unemployment tax if you have a high wage cap in your state. So if I'm going to pay $100,000, it's going to cost me $10,000 as a business. If I instead pay 80, I'll save $2,000 in taxes, and that might go towards the cost of running a 401k plan.
I'd rather pay to my employees than the federal government. That's my feeling on it.
That's priority one. Honestly, I'm going to say something that's going to be difficult for anyone to hear on this call. I hate one kind of client. Can I be honest with you? It's juicy. I hate clients who do not care about their employees. I do not want to work with them at all because
Yeah.
at the end of the day, what I'm doing is not really meaningful. It's not going to create any differences long-term for any families or any people. And it's not the kind of person I like to work with. I like to work with people who care about their staff because they realize that if it weren't for that staff, they wouldn't be driving a $150,000 AMG. They wouldn't have
Well,
that anymore, you know?
I feel the same way. And I just spell it out this way. If you're running a lifestyle business to perpetuate your business, sooner or later, it's going to bite you in the ass. Number one, your employees are going to resent you. Number two, you're not going to build a company that can survive without you. I choose to deal with and work with people who want to build a company that is based on people and profit. Those two
Exactly.
things go hand in hand. And that's what it comes down. I'm with you. I'm 100% with you. When I deal with lifestyle businesses, they never want to talk to you when they're doing well, but they won't leave you alone when they're not doing well, when business is down or when something has occurred. And
Yeah.
because they are the end all and the be all. And there's nothing wrong with lifestyle businesses, but just realize what you've created. You created a job for yourself.
Exactly. One that you're not going to be able to walk away from without selling what? Just your depreciated assets on the balance sheet. That's pretty much all you're selling, right?
And I got to tell you, I mean, I have a saying with my clients: when you stop listening, I stop talking. So when I find that I repeat myself 3 or 4 times and saying the whole same things over, and what I hear is, yeah, but my business is different. No, it's not. The thing with a lifestyle business, the thing with all small businesses, they hit a ceiling. And the ones that don't grow beyond the founder,
Sure.
okay, beyond just number one, caring for the founder, those become companies. And to me, you cannot become a company without attracting and keeping talented people. And you're not going to attract and keep talented people unless you have the things we've been talking about for 30 minutes, unless you've got the benefits, unless people portray you, oh, wait a minute, that's Ken's company or that's Ken's business versus that's Ambassador Limousine and Sedan. So at the end of the day, what you provide is basically you provide all of the products and tools that if the small business person takes advantage of them, you can be on the same level playing field with the largest companies in the country. Correct.
And it's easier, right, to do it for, the last piece I want to really touch on here, because, I know our time is coming up, is the fact that 401k and profit sharing plans, that's one document, generally one plan, right? But the ability to consider a cash balance pension plan or a variable defined benefit program, right? These programs allow the business owner, assuming they have the right W-2s and the right variables, the demographics of the organization, to take much larger deductions from the business and put it directly into the retirement accounts that they have. We've worked with a lot of organizations that might have 20, 22, 25 people where the business owner might be in their 50s or 60s, and they are successfully run businesses. They might be LLCs where everything is subject to self-employment tax. And that's important. People don't realize that, Ken. When you're talking about retirement plan contributions, Social Security and Medicare tax have to be paid on the salaries by which you are attributing a retirement plan contribution for. So
right. So you're taking distributions. You can't do
use
this.
those. So if I'm an S corp and I'm doing what's right, and let's just say I'm taking $200,000 in a W-2 and I'm taking $300,000 in a K-1, right? Distributions, or I just leave it as profit in the business at the end of the year that I'll pay tax on. That $300,000, you can't do anything with that compensation to create retirement plan contributions. You're only using that $200,000 number, which means that, yes, you might be able to get $31,000 out personally, because that's the max for anyone over the 50 year mark to defer on their own personally from their salaries. But if I want to come up with a pension plan or a profit sharing plan, it's directly tied back to that $200,000 number, not the overall $500,000 that you're profitable or taking comp on. So in that world, we're able to sit down with a 55 or 56-year-old and we can accelerate their retirement savings by millions if they have the correct variables, the components of the organization within only a 5 or 6, 7 year period, right? I'm not even kidding. $200,000, $300,000 contributions you can't do that in a 401k or a profit share, but in a pension plan, it becomes a viable solution for a business owner or their partner or together, right? Yes, you ultimately have to give something to the staff in that case. I'm not sitting here and saying you're not going to, but what you have to give to the staff, which is also tax deductible to the business, it wanes in the amount of tax savings you receive just on that $300,000 deposit, right? If you're in a 40% tax bracket, you're losing 120 grand on $300,000, right? You and I are math people. If you put 50 away for the staff and you hide 300 for yourself, you're still netting out 70 grand just in tax savings. You get my point?
And I don't know if you agree with this statement, but I find that people say, well, my CPA didn't tell me that. Your CPA is not a tax planner. They're not a benefits person.
So many CPAs are in the business of filing returns and not proactively giving advice, right? And the advice
Exactly. They're not certified, first of all. They don't have your certifications, and they're also, it's something like 90% of CPAs are not tax planning certified.
No, but like, the reality of it is that they work in the lane that they've worked in for years, and they work with the variables that they're comfortable with working on. And if that is in our industry here specifically for those that have chauffeur and companies, it's depreciation, right? That's it. That's like all you have. Maybe you can advance a few expenses before the end of the year, right? But at the end of the day, depreciation is now back on the docket, right? With the OBBBA bill.
Yeah, 100% depreciation is back, but at some point,
I was rooting against that, believe it or not, Ken. I was rooting against that because it might actually give the business owners the wherewithal to say, oh my God, I cannot continue to reduce my income and the taxes using the assets I'm buying for the business. And I thought for a second, oh my God, this is a great place for them to fit in a $200,000-$300,000 deduction for themselves and do something good for themselves long term,
Right. Well, to your point, okay, I've seen, this is a notorious story here at Driving Transactions, where we had 3 years ago, we had a client, we love him, but he shall remain nameless. On Christmas Eve, he called us, and look, we're like a lawyer. We work bankers and lawyers hours.
Right.
For around the holidays, we could take 2 weeks completely off at the end of the year. Well, this particular person called Christmas Eve and said, "Oh my God, I just we realized we made $200,000 or $300,000, and I need to go out and buy a vehicle." I spent between Christmas Eve and New Year's Eve negotiating his purchase of a motorcoach, reading over his purchase agreements. And it was like, we're not doing this anymore. So for what we do, we don't do tax planning. We give you a tax prep report. As of July, we know what you've done for the first half of the year. We know your cost structure. So we're going to extrapolate the last half of the year by looking back at your numbers, right? Last year. So we're going to give you one tax prep report in July. And then the most important one to me is the one in October. Okay. But to your point, most of these guys say, okay, well, their advice is, okay, go out and buy a vehicle and we can depreciate all of it. Well, the sad part is most of these guys are not paying for it in cash, right? And unfortunately, they're adding debt to their company. So just, and I know it's not the case for everybody, but just give us some broad strategies on tax mitigation.
Sure. So let's just suggest for a minute, let's use your story. Can we use that for a minute? You get a call on Christmas Eve. Oh my God, we have $300,000 in profit. What are we going to do with it? Right. And this is no offense to the unprepared owner, right? Which quite frankly accounts for a lot of them. What if I were to say that you didn't have to burn the profit before the end of the year to still be able to claim a $100,000, $200,000 deduction? See, most people don't realize that when the Secure Act, the original one, not 2.0, came out, it had given people a much longer time period to launch retirement programs retroactively for the year prior. So people think I have to set up a 401k profit sharing plan, pension plan for 2025. I've got to do it now. Yes, in some cases, you do have some deadlines. Safe harbor plans require deadlines and notices to participants. But profit sharing plans and pension plans, you can set up as late as the filing deadline or extension, right? For the prior year.
Or extension.
For the prior year. So right now, let me give you an example. I have an organization that we're working with in the industry, and they filed an extension for 2024, right? They didn't want to file on time, and that's fine. Some business owners don't have the time earlier on in the year.
Listen, a lot of people do that as a strategy. I get it.
And that's fine. But what we're talking about with them is where their funds went at the end of last year. Do they have
Yeah.
the funds that they can make
Yeah.
a contribution of $200,000-$300,000 and claim it in 2024 for their return? People don't realize that. So with retirement programs, yes, some plans need to be set up in the year that you want to utilize them, but other programs like profit sharing plans and pension plans, you can leave the money on the income statement at the end of the year, come back in March, April, May, June, July, and still launch a plan for 2024 and get the money off of the income sheet from like a tax perspective. So
Interesting.
it's really unique, and I'll tie this all back to the same story, right? Like it comes back to my father, right? Had my father had the good advice that maybe he would have met me, I would have told him that the CPA is doing something questionable and don't listen to them. Go find another CPA. Think about your business from a perspective of where you're going to be in 20 years and how do you get out, or 10 years or 15 years, right? And think about how you're going to accumulate the money. And when you think about accumulating money, whether it's investing outside of a retirement program, which, we're going to talk a few seconds on here, put the money away in the most tax effective manner, phase one, right? Phase one is to save as much taxes as you can. And that aligns with CPAs and that aligns with business owners. Phase two is don't overindulge in retirement programs because you're only going to have one type of dollar to pull out of an account later on. And it's all going to be subject to income taxes at that time, right? Ken, if I put $3 million in a 401k and I say, okay, I'm ready for retirement, every dollar that comes out of that thing is going to be taxable. And it's really anyone's guess on whether tax brackets are going to be higher or lower than they are today in the future, right? And so you could end up doing yourself a disservice. But then diversify out of that. So the last component of our relationships that we've really loved, and this is what I think really makes a difference, is we've aligned ourselves as quarterly advisors to review the profit and loss, identify the tax liability, pay the tax, and then figure out what does the OPEX need to look like. OPEX is operating expense reserve, right? So what does the OPEX need to look like? And what is in excess of that, right? That isn't being attributed towards a retirement plan contribution. Take it out, take the chips off the table, put it into an investment account, a brokerage account, a managed account, invest in the S&P 500, do something to earn more than what it's earning in a checking account in the business or a savings account.
Don't be afraid to do it.
And people say, well, what if my business needs it? No problem. It's as easy as taking a distribution and then making a contribution, a shareholder contribution. It's literally just the same thing that you're doing, except you're leaving it in the business, right? And what business with the liabilities that you guys have to face in your industry wants to have $700,000-$800,000 in a bank account, right?
No, it's a target. It's a target.
It's 100% a target. So what we've loved about the relationships that we've fostered and we've really molded is the fact that when you work with a firm that is equipped to navigate so many disciplines, shareholder agreements, estate planning conversations, retirement planning, benefits, and ultimately succession planning, which is what it all leads back to, right? You get an advisor that's literally like building yourself a board of directors where 2 or 3 of those roles are filled by somebody who has the knowledge, right? My biggest challenge, quite frankly, is that I need more people. I need more staff, right? That's the reality of it. But for the relationships that we've built that, we have calls quarterly, we have calls weekly or monthly, whenever we need to identify the problems. It's important to align yourself with that kind of a salesperson, right? Because we are all salespeople, right? At the end of the day, Ken, you sell your service, I sell mine.
Yep.
But the accountability measure, right, is completely different to people who are entrepreneurs like us than to the corporations that simply throw thousands of units into the marketplace on a monthly basis, right?
Yeah, and I think you're setting yourself up for disappointment. Disappointment is a small business. If you don't have a trusted advisor that you can pick up the phone and say, listen, Phil, I've got this idea. What should I be doing here? Versus you're going to be calling your rep from Paychex or a rep from any of the big companies, and they're not going to take the time to learn your business.
Correct.
It's the argument that we have with people all the time. Your CPA does your taxes. He's not interested in knowing your business.
Right.
Listen, unfortunately, we have to stop there, but tell us how people can reach you. If you want to give out your cell number, give out your cell number, give out your email.
Absolutely. So you could reach me on 973-953-1700. That's my cell phone. My office is 201-523-9997. And if you need to reach me, it's phil.shetsen, SHETSEN @prudential.com. Now, just quickly, Prudential is not my only brand. We represent everything in the industry across the board. It's just where I hung my shingle when I was 21 years old. And they let me build my own company and they let me have full autonomy, my own office, my own staff. So If anyone on this call or anyone listening to this call, obviously, has a question, my time, it's valuable, but I'm happy to make anything happen. I'm happy to help people, help educate and coach people, look at an adoption agreement. I'm not going to charge for that. I'm really there, like I said, Ken, to help, right? Prevent anyone from becoming my father. That's literally the whole thing.
And you have to give to get. That's why I do so many webinars and so many education programs, so many free white papers. And that's why we do this podcast. Sometimes we can have, a conversation that can be a little zany, but this one is important to me because, and I really wanted to have you on because it's just, when I meet people that have built a business over 30 years, it's their blood, sweat, and tears. It's the only thing they've ever done. And when I tell them, well, this is the only thing it's worth. This is what it is worth. And the fact that 20%, only in 20% of the cases do these businesses, any businesses, sell, especially 7-day-a-week businesses, it's disappointing. So my message to everybody who's listening is it's not too early to start an investment account. And my friends who own businesses with more than 5 W-2 employees, you owe it to yourself to have a benefits plan because you're going to attract better talented people who can help you build a company. Phil, thank you so much for your time today.
Ken, thank you for the opportunity. Really appreciate it. I'm so happy to share my knowledge.
Thank you for listening to the Ground Transportation Podcast. If you enjoyed this episode, please remember to subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. For more information about PAX training and to contact James, go to paxtraining.com. And for more information about driving transactions and to contact Ken, go to drivingtransactions.com. We'll see you next time on the Ground Transportation Podcast.